Welcome to the deep dive today. We're diving into the mind of a CEO
Okay.
with What the CEO Wants You to Know by Ram Charan. You share this book with us. And it's all about thinking like a business person, no matter where you sit in the company.
Absolutely. Charan's big idea is that business fundamentals are universal. Whether you're running a multinational corporation or, get this, a fruit cart on a street corner.
Okay, a fruit cart. That's a fresh take. I'm hooked already. Where does he even start with that comparison?
He paints this vivid picture of a bustling New York City street. Think hot dog vendors, those folks selling scarves, the whole hustle and bustle. He argues that these individuals are making complex business decisions every single day, even without fancy MBAs.
I see that. Deciding what to stock, how to price things, how to attract customers. It's like a microcosm of running a whole company.
Exactly. And Charan connects this to his own life. He learned business basics, not in some fancy school, but from watching his brothers run their shoe shop in India. What's fascinating is his nephews still run that shop today, proving those principles really work.
Okay, so it's not just theory, it's lived experience. If every business has this shared core, what are the building blocks we need to get?
Charan breaks it down into 4. Customers, cash generation, return on invested capital, and growth.
Let's unpack those, starting with customers. What's the CEO perspective on really knowing your customer?
It's about going beyond the data. CEOs like Indra Nooyi, formerly of PepsiCo, and Tim Cook at Apple are famous for this. They'd regularly visit stores, observe customer interactions firsthand. It's about understanding the why behind the buying, not just the what.
That's smart. You can have all the spreadsheets in the world, but there's no substitute for seeing how people actually use your product.
Right. Data might tell you people are buying a certain hammer, but observation tells you if they're contractors, DIYers, or buying it as a gift. That shapes everything, from product design to marketing.
It's like that saying, don't sell the steak, sell the sizzle. It's about the customer's experience, not just the product itself.
Exactly. And to tie it back to you, think about what you do. Do you really know what your customers are buying? What need are they truly fulfilling? That's where the CEO mindset kicks in.
Okay, point taken. Let's move on to cash flow. Isn't that something the finance folks worry about? Why should the rest of us care?
Charan is adamant that cash flow is everyone's responsibility. He makes a crucial distinction. Income is great, but see, cash is what keeps the lights on. He uses the cautionary tale of Webvan to drive this point home.
Webvan. Refresh my memory on that one.
They were an online grocery delivery company
Yeah.
in the early 2000s. Huge growth. Everyone thought they were the future.
Yeah.
Problem was, they burned through cash faster than they could make it. Bankruptcy city.
Ouch. So growth without cash flow. It's like a house of cards.
Exactly. What's interesting is that Charan gives very practical advice here. Sending invoices before Friday afternoon, for example, can speed up payments and improve cash flow. Little things add up.
So it's not just about big decisions. It's about understanding how everyday actions impact the company's financial health. That's empowering.
Right. He wants everyone to think like a business owner, seeing how their role contributes to the bigger picture. So for you, where do you see those small actions in your work that could make a difference in your company's cash flow?
That's a great question to think about. It's making me rethink some of my own processes. Okay, we've tackled customers and cash flow. What's next on Charan's list?
Return on invested capital, or ROIC. This is about efficiency, squeezing the most value from every dollar invested in the business. He breaks it down into margin and velocity.
Margin I get, profit per sale. But velocity, that sounds more like a physics term.
He uses a clever analogy. Imagine a grocery store that only takes cash. Their capital is tied up in inventory on the shelves. The faster they sell that inventory, the faster they can buy more and generate new sales, meaning higher returns on their initial cash.
So, it's like a cycle. Invest, reinvest. The faster it spins.
Precisely. And this is where CEOs really shine. They don't just focus on margin. They understand that velocity is crucial too. Walmart is a prime example. They're known for their insane inventory turnover rate on things like toilet paper.
Toilet paper. Okay. Tell me more.
They're basically selling out their entire toilet paper stock every single day. That's incredible efficiency. And it speaks to their mastery of supply chains and inventory control.
High margin. And high velocity are the keys to maximizing ROIC. Now, I'm picturing CEOs obsessing over toilet paper sales. This is a funny image.
Well, it might not be toilet paper in every industry, but the principle is the same. It's about finding the right balance of margin and velocity for your specific business. That's a CEO move, constantly asking, how can we squeeze more value from our resources?
That's about being resourceful, creative, and understanding how those levers work together. Fascinating.
And to bring this home for you, how could you improve ROIC in your work? Could you streamline a process to boost velocity, find ways to add value, and increase margins? That's the kind of thinking. Charan wants to spark.
That's a great challenge.
Yeah.
I'm already starting to see opportunities I hadn't noticed before.
Sure.
Okay, we've covered 3 building blocks now. What's the final piece of the puzzle?
The big one, growth. But Charan makes it clear that not all growth is good growth. It has to be profitable and sustainable for the long haul.
So just chasing bigger numbers isn't enough. There's a smarter way to approach it.
He uses the example of a restaurant supplier who expanded too quickly without controlling costs. They went bankrupt despite the growth.
That's a cautionary tale. It's like building a skyscraper on a weak foundation.
Precisely. Charan introduces a tool called the growth box to help identify those profitable opportunities.
Okay, color me intrigued. What's in this growth box?
It's essentially a framework with 4 quadrants based on 2 factors, existing versus new customers and existing versus new needs.
You're looking at different combinations of who you're serving and what you're offering.
Exactly. The first quadrant is about serving existing customers, existing needs, think product improvements, loyalty programs, really solidifying those core relationships.
Makes sense. It's like deepening the well instead of always digging new ones. What about the second quadrant?
That's about identifying new W needs for your existing customers. Toyota, creating the Lexus brand, is a perfect example. They saw their customers wanting more luxury and filled that gap.
Smart move. It's about anticipating how your customers are evolving and staying ahead of the curve. What about new customers, existing needs?
Quadrant 3, this is taking your existing product and finding new markets for it. Geographic expansion, targeting new demographics, you name it.
Expanding your reach.
Yeah.
Without reinventing the wheel. And the final quadrant, I'm guessing it's the most challenging one.
You got it. New customers, new needs. This is where disruption happens. Think Uber or Airbnb, creating entirely new markets by solving problems in innovative ways.
High risk, high reward. It's the quadrant of entrepreneurs and game changers.
Exactly. And Charan wants everyone to use this growth box, not just CEOs. It's a tool for brainstorming, challenging assumptions, and seeing opportunities you might have missed.
So we've covered the 4 building blocks: customers, cash flow, ROIC, and growth. My head's spinning a little, but in a good way. But how do these pieces actually fit together to create a successful business?
That's where things get really interesting. Charan challenges us to think about the total business picture, not just individual pieces.
Sounds like we've got more to unpack. I can't wait to dive deeper into that. We'll pick up right here in part 2 of our deep dive into what the CEO wants you to know. See you then.
Welcome back to our deep dive into what the CEO wants you to know. We've been exploring those 4 cornerstones of business.
Right. Customers, cash flow, ROIC, and growth.
Right.
And I'm starting to see how those pieces relate to my own work in a whole new light. But I have to admit, I'm still a little fuzzy on how they all connect to form that total business picture Charan keeps talking about.
That's where this gets really actionable. Charan puts us in the hot seat. A series of questions.
About our own companies. Pop quiz time. Feeling a little nervous, but also excited to put this knowledge to the test.
He starts with the basics. What were your company's sales in the last year? Is the company growing? What's the gross margin? Net profit margin? And inventory velocity.
Those are all those key metrics we discussed. It's like taking a financial x-ray of the business.
Exactly. And he wants us to go beyond just knowing the numbers. He challenges us to ask, why? Why are these numbers what they are? How do they compare to our competitors?
So it's not just about being able to read a financial report.
Yeah.
It's about understanding the story behind the numbers, the trends they reveal, and what they tell us about the health of the business.
Right. Charan believes being able to answer these questions, to truly grasp your company's financial landscape, is like speaking.
Yeah.
The universal language of business.
That's about having fluency in the language of money, which honestly is how most companies make decisions.
Absolutely. And that knowledge is empowering, no matter your role. When you understand how your work impacts the company's financial performance, you make smarter decisions, spot opportunities, and have a greater impact overall.
You move from being a passenger to being in the driver's seat. so to speak.
Exactly.
Yeah.
And this leads to the next big idea Charan tackles. The difference between simply making money.
Okay. And actually creating wealth. That's an interesting distinction. Aren't those basically the same thing?
Not quite. Charan argues that making money is about generating profit today, while creating wealth is about building something with lasting value.
So something that appreciates over time. It's about building something that has staying power, that continues to grow and generate value in the future.
Right. And to measure that, he brings in a key metric, the price-earnings ratio, or PE ratio.
The PE ratio. That brings back memories of my early investing days. It's basically the price of a company's stock divided by its earnings per share.
Right. You got it. The PE ratio tells us how optimistic the market is about a company's future, earnings potential. A high PE ratio suggests, investors believe, the company will keep growing and generating strong profits down the road.
So a high PE ratio, a good sign. It means the market believes in the company's growth story.
Exactly. Charan compares companies like Starbucks, known for their high PE ratio, with oil companies, which tend to have lower PE ratios, especially during times of slow growth.
Interesting. So even though oil companies make huge profits, their PE ratio reflects the market's perception of limited growth potential in that industry.
That's the key point. Wealth creation isn't just about today's profits. It's about the perceived value of future earnings. That perception is influenced by a lot of factors, from industry trends and competition to innovation and the overall economy.
So a company that consistently innovates, expands into new markets,
Right.
and shows strong growth potential is likely to have a higher PE ratio,
Reason.
leading to greater wealth creation for its shareholders.
Right. And Charan believes this connection between making money and creating wealth is crucial for everyone in the company to understand, even if they aren't directly involved in investments.
I can see how that would be motivating for employees, knowing they're part of something that's building long-term value. But why else should we care about the PE ratio?
Because it ties back to shared success. When a company is performing well and has a strong PE ratio, it creates a ripple effect. They can invest in new projects, offer better benefits, and create more opportunities for everyone.
It's like that saying, a rising tide lifts all boats. Everyone benefits when the company is thriving.
Right. Charan actually tells a story about a millennial named Brian.
Okay.
Who illustrates this perfectly. I'm always up for a good story. What happened to Brian? He started out at this big, stable retailer, climbing the corporate ladder and making good money. But he got frustrated by the slow pace of change and the lack of opportunity to make a real difference.
It sounds like he was feeling stifled, like his potential was being kept.
Exactly. He ended up leaving that secure job to join a smaller, faster-growing company where he could have more impact.
He took a risk to pursue something more fulfilling, even though it might have been scarier. Did it pay off?
It did. He found the work way more rewarding. He felt valued, and his contributions were directly tied to the company's success.
It's a good reminder that aligning your own goals with the growth of the company can be incredibly motivating.
Absolutely. It's about finding a work environment where you feel challenged, where you can grow, and where you see the value of your contributions. But now the question is, how can companies manage that PE ratio, that engine of wealth creation?
Yeah. How do you make sure your company is one of those high PE success stories?
Charan says it starts with consistently executing on those 4 building blocks we discussed. Understanding customers, managing cash flow, maximizing ROIC, and pursuing profitable, sustainable growth.
Yeah. It's about having a solid foundation, proving you can deliver results, and telling a compelling story about the company's future potential.
Precisely. Companies that do this well, that build trust and confidence in the market, are rewarded with higher PE ratios.
And that higher PE ratio allows them to attract talent, invest in new ideas, and ultimately create more value for everyone.
It becomes a self-reinforcing cycle of success.
This is all making a lot of sense. But what about companies that aren't publicly traded? Do these principles still apply?
That's a great question. It leads us into the world of mergers and acquisitions, which is a whole other layer of the business landscape, even if you aren't directly involved in those deals. Charan says understanding their dynamics can be incredibly valuable.
Okay, sign me up. Mergers and acquisitions sound like a high-stakes game, and I'm ready to learn more.
Then buckle up. We'll dive into that fascinating world in part 3 of our deep dive into what the CEO wants you to know.
Welcome back to the deep dive. We're wrapping up our exploration of what the CEO wants you to know, and I'm ready to tackle this whole merger and acquisition thing. It sounds like a pretty intense world.
It can be. And while it might seem like something only CEOs and Wall Street types deal with, Charan makes the case that understanding mergers and acquisitions is valuable.
Really?
Well,
for anyone in business, why is that? How does this knowledge benefit someone who's not like negotiating these massive deals?
For one thing, it gives you a better understanding of the competitive landscape. Mergers and acquisitions can completely reshape industries, create new power players, and change the rules of the game overnight.
So even if your company isn't directly involved, you need to be aware of how these deals are impacting your industry and potentially your own company's strategy.
Exactly. It's about understanding the forces at play, the shifts in power, and the potential threats or opportunities that might arise from these transactions.
It's like paying attention to the global economy. Even if your country isn't directly involved in a trade war, you still need to understand how it's affecting things globally and how it might impact your own business.
That's a great analogy. And Charan points out that mergers and acquisitions often happen because a company is struggling with those core money-making principles we've been talking about. They might be losing market share, their margins might be shrinking, or their growth might be stalling.
So a merger or acquisition can be a way to try and fix those problems.
Yeah.
To gain new capabilities.
Yeah.
Or to get a stronger position in a particular market.
Right. But Charan is very clear that the success of these deals hinges on more than just the financials. It's about integrating cultures, aligning strategies, and creating a combined entity that's truly greater than the sum of its parts.
That sounds incredibly tough. It's like trying to blend two families together. Yeah. Each with its own history, traditions, and way of doing things.
Perfect. Analogy. To illustrate this, Charan uses the story of AMP, an electronic components manufacturer that went through multiple acquisitions and ownership changes.
It's okay. I'm all ears. What happened to AMP?
They were once a leader in their industry, but they lost sight of those money-making fundamentals. Their performance tanked, and their stock price plummeted.
So they became a prime target for a takeover.
Exactly. And they were eventually acquired by Tyco, a conglomerate known for its aggressive acquisition strategy.
Did Tyco manage to turn things around?
At first, yes. They cut costs, improved margins, and got AMP back on a growth path. But then Tyco itself ran into problems with scandals and financial mismanagement.
So the rescuer ended up needing rescuing.
It's kind of ironic, isn't it? AMP, which was renamed Tyco Electronics, was eventually spun off as a separate, publicly traded company. But here's the interesting part. Under new leadership, they went through a major transformation. They focused on innovation, streamlined their operations, and expanded into new markets.
Wow. So they basically reinvented themselves after this roller coaster of acquisitions and ownership changes.
They came out stronger and more focused, proving that even though these deals are complex and difficult, that they can sometimes lead to positive change.
It's a good reminder.
Yeah.
That even in the middle of chaos, there's opportunity for growth and reinvention.
Absolutely. And this leads to the key question Charan poses. How can companies avoid becoming a takeover target and stay in control of their own destiny?
And it's the million-dollar question. What's the secret?
Charan says it comes back to those money-making fundamentals we've been discussing. Companies that consistently deliver strong financial performance, innovate, and create value for their customers are less likely to become prey.
So it's about building a strong, resilient business that's focused on the long game. It's about being the acquirer, not the acquired.
Exactly. And this brings us to Charan's final point, which might be the most important one. He emphasizes the need to constantly monitor trends, ask why things are changing, and be proactive in adapting to the ever-evolving business world.
So it's not enough to just know these principles. You have to actively apply them, analyze your company's performance, and always be looking for ways to get better.
Yeah, precisely. He uses Amazon as a fantastic example of a company that has truly mastered both making money and creating wealth. When you look at their financials, it's clear their success isn't just about profit. They prioritize cash flow and long-term growth over short-term accounting gains.
That's interesting. So they're playing the long game, investing heavily in innovation and building a really solid foundation to support their ambitious plans.
Exactly. And Charan encourages us to think the same way. Be curious, ask questions, challenge assumptions, and always look for ways to create more value for customers.
And the company. It's about being a lifelong learner, always seeking knowledge and using it to make a real difference. That's something anyone can do, regardless of their role or their industry.
Absolutely. And that wraps up our deep dive into What the CEO Wants You to Know by Ram Charan.
This has been incredibly insightful. I feel like I've learned a ton about how successful businesses operate. Thanks for guiding us through it all.
Yeah, my pleasure. Remember, no matter where you are in your career, you can use these principles to make better decisions, contribute more effectively, and create more value for yourself and your company.
So for those of you listening out there, here's a final thought. Think back to those 4 building blocks of business. Customers, cash, ROIC, and growth. Which one feels like the most powerful lever in your company? What would happen if you could shift that lever, even just a little bit? It's something worth exploring. Thanks for joining us on The Deep Dive.